Today on Your Money, Your Wealth, do you have to transfer money from a 401k to a traditional IRA before you do a Roth conversion? Does the Pro-Rata rule apply to a Roth conversion from a traditional IRA that was rolled over from a 401k? Can you do a direct interplan conversion from a 401k to a Roth? The fellows will also get into strategies and logistics of paying the tax on a Roth conversion. And what the heck is bent crude oil? But first, there have been a few updates to the provisions in the Coronavirus Aid, Relief, and Economic Security, or CARES Act, around Paycheck Protection Program loans, required minimum distributions, and coronavirus-related distributions from retirement accounts. Got questions you want answered on the podcast? Click the link in the description of today's episode in your podcast app, then hit the banner that says Ask Joe and Big Al on air and send them on in. I'm producer Andy Last, and here are the hosts of Your Money, Your Wealth, Joe Anderson, CFP, and Big Al Clopine, CPA.
We got Renee from Los Angeles. LA, huh?
Yeah.
Will there be renewing or extending the CARES Act?
Will they?
Who's they?
Yeah. Them.
The man.
The people that do the CARES Act.
I don't know, Renee. I mean, I don't know what the question is meaning. The CARES Act is
It's a lot of stuff. Well, here's what I think Renee's asking. Am I going to get another check? I bet you. I'm reading between the lines, or maybe she's asking about unemployment being extended.
Sure.
So I would say this. I've got an article here, Joe, that talks about this. Second stimulus check. Will it be happening? How much can you really count on? And it seems like across the board, Democrats, Republicans, and the president are thinking there's going to be at least one more stimulus check. How much? There's proposals between $1,200, which is what it was the first time, all the way up to $2,000. There's been proposals from one more $1,200 payment all the way to $2,000 a month for up to 12 months. Which that would be expensive. Talk about our national debt. I don't think that one's going to pass. But at any rate, Mitch McConnell is saying that sometime later this month it'll likely be announced, and it would probably be in the August timeframe.
What about? Well, I guess with the CARES Act, a couple of changes. They're extending the PPP loans.
Yep.
Right. So for small businesses. There's 2.5 times monthly payroll up to $10 million.
Right.
So they're extending those loans.
Now the unemployment, I was going to say, now that expires July 31st, and so far there's no discussion.
Well, the kicker, the $600 extra.
Correct. Yep.
You got the required minimum distributions. So initially, if you took your RMD in January, you were only eligible to pay it back if you wanted to with a CRD, or coronavirus related distribution, but they changed that. So now any required distribution from any account, so it could be from a beneficiary IRA, because before, if you took a distribution from a Benny IRA, you were stuck with it. So that they changed that. So that could be renewing, the changing CARES Act 2.0. There's been a little bit more talk about who is eligible for the CRD of the coronavirus related distribution. It was pretty broad brush when they first wrote the bill. So, you had to be diagnosed with COVID, a spouse or dependent. Maybe you were furloughed, lost your job.
Or even if you lost some work hours. So so you got less pay. Or if you had childcare situation.
And then it was like any other thing, right?
that we deem appropriate,
right? Which
probably is about 90% of all the people out there.
Exactly. So I think more and more people will be eligible to take the CRD. But stay tuned, right? Because now we're kind of getting into some weird territory where we opened up, and then now some industries are shutting back down with the bars and restaurants.
Right.
And
yeah.
What does that look like for those employers? So there's going to have to be another stimulus package if they're going to.
It seems that way.
Shut down, the economy, or try to shut down some of the economy, I guess, depending on what industry that you work in. So stay tuned. We'll probably day by day, week by week, we'll probably get more information there. So. Thanks for the question, Renee. We got Shirley from Irvine, California. Our RMDs only wait for 2020. I already took my RMD in March of this year. Can I put it back into my IRA? The answer is yes. So if you took a required minimum distribution, that is when you turned 72 now due to the Secure Act, is that there's a certain percentage that you have to pull from a retirement account and pay the tax on that. And what they did is they said, well, you know what? Because of the volatility and everything else that's going on in the overall markets for retirees or people that are of required minimum distribution age or reach their required beginning date, you don't have to take it. You don't have to pull the money out. So you can save some taxes there if you choose to. So if you don't need the money before, you would have to take it out, pay some tax, and then just reinvest it in a brokerage account. Due to the CARES Act, you do not have to take the RMD.
Yeah, and Joe, that is only for 2020.
Correct.
1 year. And this is a recent pronouncement that just came out within the last month, I would say, which is now they said that you can put it back. If you took your RMD, even in January, February, March, whatever, you can put it back, no taxation, no 30-day or 60-day rollover rule. So it doesn't count as your once a year rollover. So you can just put it back. So anyway, that's different than what we had said in other shows because the law just changed. But you have to put it back in by August 31st, I believe. I think that's the date.
That is correct.
Yes. If it's grown in value, no big deal, right? Because it's just going to be taxed at ordinary income at the. Let's say you took your distribution of 10 grand.
Yeah, right.
Right, and you still invested it. You put the. Well, I wonder what you put back. I guess probably just the required distribution.
I think
amount.
you just put the 10 back, and then you have ordinary income. You keep the rest, and you just pay taxes on it.
Yeah,
I think that's how they would do that.
Yep, exactly.
Yeah.
Okay, I have no idea. How do we pronounce this name?
Chandrakant.
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 Do you know a Chandrakant?
It's a very common Indian name.
Oh, all right. Chandrakant from Atlanta, Georgia. Can RMD withdrawals be converted to a Roth IRA? Answer is no. A required minimum distribution is a distribution. RMDs cannot be converted to a Roth. This year, though, there is no required minimum distribution. So if you're used to paying the tax and the tax rate is low enough, it might make sense to continue to take that distribution. And this year, you could convert it to a Roth. But you do not have to take the RMD this year.
Yeah. So in other words, instead of taking the RMD withdrawal, just take what would have been your RMD and put it in a Roth IRA. It's the same taxation as what you're used to anyway, and that way you do a Roth conversion. 1 year only, 2020.
That's it.
Is there any chance that they're going to extend that?
Why do you care? Are you 72?
I'm curious, and I think that our listeners would be interested.
No, I don't think so.
I don't think so either, but never say never,
No.
right?
No.
There's been no discussion of that. I'll put it that way.
Got it.
You want to ask some Social Security questions, too?
No.
Got it. All right, we got what
Stop
the hell
Ironing
is-
Shirts is a blogger.
Okay.
And Josh is a listener of YMYW, and they had a conversation on Twitter. So I shared it with you because I thought you might want to give more information here in this conversation.
Well, please tell me more.
So Stop Ironing Shirts says, has anyone weighed the pros and cons of a CARES Act 2202 distribution versus a Roth IRA conversion? 2202 is taking a distribution today and spreading the taxes out. So it's a coronavirus related distribution.
CRD.
Josh
See,
says,
this stuff as easy as it looks, is it?
Josh said, I heard YMYW show, that's our handle on Twitter, talk about this several times in the past few months. Need to be able to demonstrate that you've been affected by COVID-19 to be eligible for the COVID-related distribution or whatever CRD stands for. But there's an opportunity there to explore. So obviously Josh does actually pay really close attention to the show. Stop Ironing Shirts replied and said, interesting. I'm 61% plus pre-tax accounts and can meet the requirement. My side hustle was terminated due to COVID impacts to their business. Only downside I can find is those investments start kicking off taxable income and aren't sheltered from liability.
Okay. But he's saying he wants to do a Roth conversion with the CRD.
That's I think what he's saying, and I think he means 2020. 2022 is about 200 years from now.
But
No, isn't that the actual name of it?
Isn't that a sub-chapter of the CARES Act of the CR?
Oh, is it?
He's
Okay.
saying. He's trying to be little fancy pants.
Got it. See, that was over my head.
Yeah, see, I'm tight. I like memorizing the code.
I know you do. Yeah, right. Smarter. Right.
All right. Well, you can convert. So he wants to take a COVID-related distribution. So you can pull money out of a retirement account up to $100,000, and you can either pay the money back over a 3-year time period, or you could pay the tax over a 3-year time period. So what? Stop ironing shirts. What the hell is that all about? I mean,
It's something to do with the fact that he's retiring early, so he doesn't have to iron his shirts anymore.
Oh, okay, got it. Cool. So he's thinking, all right, I'm going to take the 100,000 or something amount no greater than 100,000.
Yeah.
I'm going to convert it, and then I'm going to pay the tax over a 3-year time period.
Yeah, which sounds like a great deal.
Right. And then, so our buddy Josh, who's an avid listener, gave us little props and said, you know what, hey, be careful with that because you need to be affected by COVID. And the Stop Ironing Shirts person said, well, hey, my side hustle, right, FIRE movement, blew up, so I qualify. So be careful about converting. In the law, it does not say you cannot. We believe that that's not the intention or the spirit of the law. But it still makes sense to take the money out of the retirement account, potentially pay the tax over 3 years, depending on what your tax bracket is. So let's say if you get your side hustle back in the next few years, you could potentially, or how much money that you have in a retirement account, what tax bracket that you're in. So there's a lot of pros to take it, but the con is, you're right, is that now the interest in income and dividends that are sitting in a non-qualified account will be taxable. But when you sell those assets, it's going to be taxed at capital gains rate versus an ordinary income. And yeah, if it's from liability, so let's say you get sued, or not sued, but maybe file bankruptcy, you will be protected under the retirement accounts, but not necessarily protected in a non-qual.
Well, it depends, right? Because some IRA money, depending upon.
But no, if he does a CRD, it's in a non-qual account.
Yeah, I understand. But if he converts it.
Yeah, well, then he's kind of. So if he converts it, it's still in a retirement account. It's going tax-free, but yeah, I don't think that's.
Well, if you listen to Jeffrey Levine, who we've had on our show, probably one of the smartest guys in our industry about taxation, what he says is that it doesn't really say you cannot take the coronavirus distribution and convert it, but his strong belief is don't do it. That was not the spirit of the law, and probably, or at least that's his opinion, that the IRS will at some point come back, or government will come back and say, no, this wasn't allowed. You'll have to undo it and have penalties. And so I personally wouldn't try that. I think the decision is either make a normal Roth conversion, right, from your IRA to a Roth and just do it normally, or take the coronavirus related distribution. The plus side of that is a lot of people that we end up talking to don't have hardly any non-qualified, non-retirement money. And this is a good way to get some out, not have any penalty, and pay the tax slowly over 3 years. So if that's your situation, I think that's not a bad way to go, really.
So, but he's only got 61% of his money in pre-tax accounts. It's not 95%.
Yeah, that's true too.
So he does have some diversification in regards to, the taxation of the dollar.
Yeah, good point.
When he stops ironing shirts.
Right.
So
they actually, I'm at stopironingshirts.com right now, and they're a mid-30s couple who achieved financial independence at 34 and retired at 36. So they're out. They stopped ironing their shirts a while ago.
And another actually for the FIRE movement, for those that are going to need income until they turn 59 and a half, here's a way to get money out without paying a penalty. So you got $100,000.
Right. Most FIRE people, especially in their 30s, they hate retirement accounts because you can't spend the money until you're 59 and a half.
Right.
So you could take a CRD, put it in a non-qualifying account, or buy business, buy some real estate.
Yeah, right.
It's like your boy Cupert or whatever his name is.
My boy. God.
So, all right. Well, there you go. We haven't talked FIRE in a while.
No, we haven't.
So, well, congratulations to Stop Ironing Shirts. And thanks, Josh, for the little plug.
Learn how these recent government programs can help you through the tough times, changes the IRS has made that can cut your tax bill, how the stock market sell-off can set you up for a tax-free future, and tips and strategies for surviving financial hardship, and much more in Retirement Revamp, Financial Planning in Times of Crisis. This is a new ebook from Pure Financial Advisors EVP and Director of Research, Brian Perry, CFP, CFA. Available as our free special offer at yourmoneyyourwealth.com and in the podcast show notes for a limited time only. Click the link in the description of today's episode in Apple Podcasts, Stitcher, Pandora, Spotify, or your favorite podcast app and download Retirement Revamp for free. Do it now because it won't be available for long.
We got Miss M.
Miss M, that's a cool name. What do you think? Mary?
I don't know. I like Miss M.
Madeline?
Madalena. Sacramento, California. She writes in, "Hi, Joe, Al. I truly enjoy listening to your podcast this year so far." Oh, maybe
It's all down here from here, Miss M.
So far.
So far.
I'm reserving my judgment
Yes.
until I listen to a second one.
You guys are not only funny, but also give honest suggestions, and I appreciate that you try to answer a question in many different ways, especially when information needed is missing. Thank you for being fun characters on the air. All right, cool.
Yeah.
We all need a good laugh, especially during times of
This
adjusting
time.
to a new normal.
Especially during this time,
Yes,
adjusting to normal.
it's a new normal.
Yeah.
Andy, you are the best podcast producer.
Dang, I wonder how many of them she knows.
I think Andy just kind of popped
Well, I was wondering,
popped that in there.
like if that would have been like a different type, a different font.
I thought it would be bold, underlined.
Then we know Andy has something to do with that.
So I have a question I'm hoping one of you can answer. I searched all over the internet but can't find a clear answer. I'm asking for a friend. Of course you are.
They
Miss
always
M.
ask for a friend.
Yeah, right, exactly. Friend, 74 years old, who rolled over all of his 401k to a traditional IRA account upon his retirement and has been taking RMDs every year since turned 70 and a half. The traditional IRA has a zero balance.
Had, keyword.
Had a zero balance at the time of the 401k rollover, and no new contributions have been added to the IRA account since. If he converts some of the IRA money to a Roth IRA account this year or any future years, does the Pro-Rata rule apply? Thanks, Miss M. All right, Miss M. Few things here. So the Pro-Rata rule, let's kind of talk about what that is that this is the Pro-Rata rule only applies if there is basis in the IRA. And what that means is that did your friend,
Your 74-year-old friend.
I can see the air quotes.
Yeah.
like make after-tax contributions? Because what could have happened, Al, is this, and we've seen this mistake in the past, is that I have a 401k plan. I have after-tax contributions in the 401k plan. I have pre-tax contributions in the 401k. When I say after-tax, it's not Roth. It's after-tax, where the earnings of the after-tax earnings will grow tax-deferred and be taxed at ordinary income rates. He could have rolled everything into an IRA,
Including after tax.
including after-tax.
Right.
And then, yes, the pro-rata rule would apply, but they made a huge mistake in the rollover,
Agreed.
because the after-tax money from the rollover should never have went into the IRA. It could have gone directly into a Roth IRA.
Yeah, and that's a relatively new rule. What 5 years ago? Something like that?
Something like that.
I mean, we had a kind of
A work
funny way that we and some other advisors did sometimes, but it was not a sure thing. So we kind of used it cautiously. But yeah, that would have been the miss. And just so people understand, after-tax money in a 401k, how do you get that? Well, typically a 401k is either a traditional 401k or a Roth 401k, and it's $19,500 per person this year, or $26,000 if you're 50 and older. But some plans, not all, some plans allow you to put more money than that $19,500 on an after-tax basis, meaning that you take money that has already been taxed. In other words, it's taxed on your paycheck, right? And then you put that into your 401k. That gives you basis so that when you withdraw that money later, you don't have to pay tax on it because you already paid tax on it. That's what after-tax money is. And so some plans and some people have tax basis in their 401ks. And if that's you, then instead of rolling it all to an IRA, you roll the after-tax part directly to a Roth. You're allowed to do that. You roll the rest to a regular IRA. Then there is no basis in your IRA, and you don't have to worry about any of this
Pro-Rata rule.
Pro-Rata rule.
And a Pro-Rata rule works like this, is that, let's say there's $100,000, but out of the $100,000 or is, 10% of it's after tax. So 90% of the dollar that you withdraw would be taxable, and then 10% would be tax-free.
Right.
So that's how the pro-rata rule. So every dollar that comes out, it's pro-rata from after-tax to pre-tax, depending on the tax treatment. However, since she applauded us on trying to figure out what the hell they're actually asking us, here's another thing, another thought that maybe she's asking.
Okay.
Is that because the IRA had a zero balance, they took a 401k and rolled it into an IRA. And if they're 74, do you think a 74-year-old still working?
They'd have to have like a side gig.
Right.
It does
maybe.
say he rolled it upon his retirement, which implies that he is not working anymore.
Okay.
Yeah, but I get what you like. If let's say he had a side gig, so I know where you're going.
Right. So then maybe he wanted to do a backdoor Roth.
Right.
And so since the IRA balance was zero, put a 401k into that IRA. I open up another IRA, and then I put after-tax dollars into that IRA, and then try to convert it to a Roth IRA.
Right.
Then the pro-rata rule would still apply there.
Yes,
because
it
you
would.
look at the aggregate of all IRAs, and then you say, all right, well, what is pre-tax, what's after-tax? And so to figure out what's pro-rata.
We have a few retired folks that have a side gig, and that's profitable. It has to be profitable to do this. And then we have them set up a solo 401k or individual 401k. They roll their pre-tax money from the IRA into the 401k, and they're left with an IRA with after-tax money that then you can convert that and then continue to do backdoor Roth. So we have done that before.
Well, wait a minute. I should have read it more clearly, because she says, Miss M says, well, no, there hasn't been any future contributions.
I know, but you kind of went down the path. What if there was?
Sure.
Yeah, but you're right. It was a kind of a fork in the road that didn't really matter.
True.
But maybe for some of our listeners, maybe not for Miss.
Yeah, maybe they could
Miss
apply
M.
that knowledge to their own situation.
Yeah, that's what I was thinking. It was very clever.
So I don't know, Miss M. If they rolled after-tax dollars from a 401k plan into the IRA and they do the conversion, then yes, the pro-rata rule still applies. But the pro-rata rules, maybe she's confused on what pro-rata means. Pro-rata is after-tax versus pre-tax, and if you do a conversion of X amount of dollars, some of that's going to be tax-free from the conversion.
Sure.
Via pro-rata, what's pre-tax and after.
So here's the question: Is Miss M is M a first name or last name? Do you think?
Miss M? I
Yeah.
would say first name.
First name? Yeah.
What do you think?
Well, that's what I was thinking, but then I started thinking maybe like it's Manchester, something really cool like that. Miss Manchester.
That's really cool, Manchester.
I think so.
Okay,
That's the name I wanted.
got it. Manchester.
Manchester. Big Al Manchester.
Got it. All right. Hopefully that makes sense. All right. Our boy Smitty
From Oregon?
Yeah, where's he been? Roseburg. Was he on the webinar that we did?
Not that I'm aware of.
I don't understand. So these guys keep asking us questions, and we throw a webinar for people that like to ask multiple questions. Then they no-show us.
We may
Right.
have to do it on the weekend because a lot of people work.
But we do it at lunchtime.
Yeah, and it's a Zoom meeting. It could pretend it's a very important Zoom meeting.
Oh, I'm going to remember that next time.
Everyone's
like
on
something
Zoom
like
right
that.
now.
Everyone's
so
Zoom.
It's to be expected that you'd be on a Zoom meeting.
Of course. What are you doing? I'm on a Zoom call.
Yeah, leave me alone.
Get the hell out of my house or get out of my bedroom.
Yeah, right.
All right. Hello, Andy, Joe, and Big Al. I have a mission for you if you choose to accept it.
Ooh, it's like
Mission
Impossible.
I like
Yeah.
it.
Yeah.
Dun,
I'm
dun,
age
dun.
64, finally jointly making $150,000 a year. I'm thinking about doing a rollover from my tax-deferred 401k and converting it into my Roth IRA. I'd be paying all the taxes via my brokerage account, and I'm aware of the capital gains tax associated with doing so. It's my understanding that if I do a 401k rollover, that it would first need to go into a traditional IRA before it can go into a Roth IRA. It's also my understanding that if I do Roth IRA conversion and some of the money is left behind in the traditional IRA, then that money would be would also be calculated in taxing of my Roth IRA conversion. So this gives me pause on what would be the proper steps and timeline to eventually get all of my 401k money into a Roth IRA while staying in the 24% federal tax bracket. Let me give you two scenarios, and maybe you could give me an idea of which scenario would generate the lesser amount of tax. Okay, scenario one, 400K equals 700,000. I roll over $700,000 from my 401k to a traditional IRA, then I convert $100,000 of it to a Roth. I will continue to convert $100,000 per year until all of the money has been converted into my Roth IRA. In the end, the total tax would be X. Okay? Scenario two, 401k equals 700K. I roll over $100,000 from my 401k into a traditional IRA, then convert the $100,000 to a Roth IRA. I would continue the scenario every year until all the money in the 401k has been rolled over to the traditional IRA, then converted to my Roth IRA. In the end, my total tax would equal X. Keeping in the 24% tax bracket, which scenario do you think would create the less amount of tax and would end, or would it all work out to be equal in the end? Thanks. Schmitty, you got to start watching our webinars, bro. Because I don't know what so it's the same.
Yeah, the answer is equal.
Equal. Yeah, your tax is X and X. You're right on there.
Well, first of all, you do not have to take your 401k money to an IRA to do a Roth conversion.
You can go 401k directly to a Roth IRA.
Yes, so keep that in mind. You don't have to go through this step if you want, but I don't care whether you go directly from a 401k to a Roth and do that over 7 years, or you roll the whole thing out to an IRA and you do that sequentially over 7 years, or if you do 100,000 a year from one to the other, which you don't need to do, but it works out the same.
It's all right. So if I were Schmitty, I would roll the 700,000 into the IRA and then do the conversions there. It's just easier because then you can just transfer shares from one IRA to the Roth.
You're not having to request the money out of the 401k, which is a hassle.
Right. You got to do rollover paperwork or transfer paperwork.
I do agree with that. But here's a concern I have, and that is it sounds like he wants to convert his entire 401k, which I'm not necessarily against. But here's what sometimes people do is they end up converting everything in a higher bracket, like 24%. And then by the time they get to retirement, they have no required minimum distributions. And if they don't have much other income, now they're in basically a 10% bracket. So you convert it and pay it at 24%, while if you pulled it out with RMDs, you would have been in a much lower bracket.
Schmitty, you make $105,000 a year. So with $105,000, his taxable income is probably $80,000.
Yeah, well, it depends whether he's married or not.
Did he say he's married? Finally, jointly, it's married.
Oh, okay, yeah. Okay,
so,
very good.
Did you know what that means?
Yeah, I do know what that means.
All right, so $80,000. You're at the top of the 12 at $80,000 of taxable income. So if you want to convert $100,000, then that's going to push you into the 24. You're going to take it all of the 22. So if your taxable income is $80,000, the top of the 22 is $170. So maybe you convert $90,000 to keep in the 22% tax bracket. You don't even touch the 24. So just kind of like look at the brackets again and look at your taxable income. So I would do an IRA rollover from 401k, put it into the IRA, open up the Roth at the same custodian, whatever, Vanguard, Schwab, Fidelity, I don't care. And then just max out that bracket. I think the 22% tax bracket is okay. If he's got $700,000, the top of the 22 is probably the right answer. I would not probably touch the 24 because he could. I'm not sure how long he's going to continue to work either. Because if he's 64, I don't know, maybe he works until when? Let's just say the next 4 or 5 years at $105,000. You could still convert, let's say, half.
Yeah, you could convert a lot. All I'm suggesting is it depends upon, like, let's say Schmitty's got a lot of pension income. then he's going to be in a high tax bracket. I totally agree with this. But let's say he's got no pension income,
Right.
and he's got no rental property income. He's got very little other income except for what's in his 401k and his Social Security. Then I would not necessarily convert it all, because now you're paying in the 22% bracket when you could have been.
And then the future, he's going to be in the zero.
Yeah, zero, or what will be the 15% bracket. So the other step in this, I agree with everything you said, Joe, but you also want to look at what tax bracket you think you're going to be in retirement to help you with this decision.
Right. And then you want to make sure it's strategically balanced. There is a formula, but it's not as easy as saying you want a third in a Roth and a third in a brokerage account and a third in a retirement account. It's really looking at, okay, well, if I did nothing with all of my other income sources and assets, when I retire, what tax bracket potentially am I going to be in?
Yeah.
And then you look at, or if you're going to retire prior to 72 now, then you look at age 72 to say, all right, well, what does this do when RMDs hit? So then you can kind of guesstimate what tax bracket that you're going to be in. So then that's kind of the easy step to say, well, if I'm going to be in the 24, it makes sense for me to pay 22 because I know the 24 is going to 28% in a few years anyway.
Right.
So then, right, you're paying less tax. But I also agree that you don't want to overshoot this thing and blow your load, and all of a sudden you're paying a lot more tax than you needed to.
Right.
If you missed the YMYW webinar Joe mentioned earlier, catch the replay in the podcast show notes at yourmoneyyourwealth.com. Click the link in the description of today's episode in your podcast app to see the fellows and I navigate our way through viewer questions on the CARES Act stimulus package, investing strategies, tax diversification, Roth conversions, and much more, all on camera. In the webinar and in the podcast show notes, you can also sign up for a free tax reduction analysis to take a deeper dive into your personal financial situation to see where you might be able to lower your tax burden. Click the link in the description of today's episode in your podcast app to go to the show notes and sign up.
We got ZC from Washington State.
It's quite a name.
Love it.
You know, I think if you're a parent going, you know what, I think I want to name you ZC because I want you to be dead last in everything that ever happens in school, because it's all alphabetically.
Well, why would anyone want their kids to be dead last at anything?
That way they can not have to go first. They can watch everyone else. Get schooled by everyone else.
Got it. Everything that you said there was very negative. Get schooled. You should say, you can learn from.
Yeah.
Get schooled is like you're getting schooled.
Yeah.
Like I'm going to school this question here.
All right.
Hello, Joe, Alan, Andy. This is my second email to the podcast. Well, there you go. Repeat listener. Tax year 2020, I have been contributing to an after-tax in my company 401k administrated by Vanguard. The plan does not allow for in-service distribution conversion. However, they allow direct rollover, and I want to take advance of that. Here's what I'm planning to do. Okay. So I think she's getting confused with some terminology here.
Yeah, a little bit.
Number one, Vanguard will liquidate the funds purchased with my after-tax money. Total proceeds is $2,100. $2,000 is my after-tax basis in a $100 gain. Step two, Vanguard will move $2,000 to my Roth IRA, $100 to my traditional IRA. No, I've already contributed to my 2020 year non-deductible $6,000 IRA and converted that to a Roth IRA earlier this year. Here's my questions. Can I convert the $100 from my traditional IRA to my Roth IRA? Will I be breaking any IRS rules by doing so? The answer is no, because what she's thinking is that she's thinking of contributions versus conversions. And if that extra $100 was classified as a contribution, then the answer would be no. But as a conversion, there is no limit to how much money that you can convert as long as you pay the tax on the $100.
Absolutely. Yep.
How many times a year can I move this after-tax money? Well, as many times as the plan allows.
Yeah, there's no limit there.
So can I repeat the same process next year and not violate any rules? Yes, it all really depends on the plan document, but if you're looking at IRS rules, no, you're fine. Question 4, is there anything else I should consider? Thanks for your taking my question. No, all right, so what she's doing is she's got a 401k plan, and there's after-tax dollars that can go into the 401k plan. So $19,000 is the most that you can put into a plan, $25,000 if you're over 50, is it 19.5 and 25.5?
19.5.
Yeah, 19.5 and 25.5, or is it 26?
Well,
I don't know how that just escaped
it's
my brain.
19.5 and 26.
Yeah, 26.
Sorry.
Yeah. Okay. See, I knew it'd come back.
Yep.
Just had a little brain fuzz. So
See, that's now that you're getting older.
yeah, right. So she's asking, can I put more money into the plan? If the plan allows, the answer is yes, up to 50 some odd thousand bucks. So let's say she's putting $25,000 in, she can put in another 25 grand. The other 25 grand is after tax.
Right. Yep. You have to subtract out your employer's contribution, so that gets taken off of that. But yeah, if some plans allow you to put after-tax money in, and you should, because you can take that after-tax money and have that sent right directly to a Roth IRA. It's a great way to go.
So when you say how the plan does not allow in-service distribution or conversion. So your words are wrong here. So it's like an inner plan conversion is what she's talking about.
I think so. Yeah.
So taking pre-tax from the 401k, moving it to the Roth side of the 401k, but it allows an in-service distribution because that's what you're doing. You're taking the after-tax dollars out of the overall 401k account and you're moving those after-tax dollars into a Roth. Any earnings, then you're pushing those into an IRA, and then you're converting the earnings into the Roth and paying the tax on the earnings. You could do that way is fine, or you could put the whole after-tax plus earnings into the Roth and pay the tax on whatever the earnings are. So what you're doing is fine. Keep doing it and maximize that as much as you possibly can.
Yeah, and I agree. It's up to the plan. If the plan lets you do it every month or quarter, go for it.
Yeah. I mean, that's just a lot of hassle and paperwork. I'll do it annually.
Yeah, me too.
Right.
So
just maximize it, and then each year you just pop it out and put it in the right accounts. Adam from Pennsylvania. Imagine this. We got another Roth conversion question.
It's amazing.
Joe and Big Al. Roth conversion question from a couple in their early 30s. All right. Should I focus on maxing out our Roth IRA accounts, $12,000 cumulative each year, or is that $12,000 better used to cover the taxes on Roth conversions of our existing $170,000 pre-tax 401ks? Both of our employers offer Roth in-plan conversions. Our income puts us in the middle of the 22% tax bracket, 3% state tax bracket. We have cumulative pre-tax 401k balances of roughly $200,000, Roth balances of $20,000. We have a $150,000 mortgage, 2% on a $200,000 property, $15,000 auto loan, no other outstanding debt, fully funded emergency fund. I like this question, but the only thing he left out, he's in the 22% tax bracket. I'd like to know what his income is in regards to what's he saving in the 401k plans, because he's probably making $100,000 to $170,000 a year.
Yeah, somewhere in there.
He's in early 30s. He's already got $200,000 saved. It's pretty impressive.
Yeah, that's good. Well, I think I would answer it this way. I mean, if it's 22% federal and 3% state, that's a 25% tax rate. So if you save $1 to do Roth conversion, you're going to be able to get $4 converted and pay the tax with the dollar. Or if you do a Roth contribution, $1 equals $1. So I'd rather save the money if I have a choice. I'd actually like to do both.
Yeah.
But if there's a choice, if there's only one choice, I'd rather do a conversion because I can get about 4 times as much money into a Roth by paying the tax with the $12,000 than I can doing a contribution.
I would disagree with that. I'm going to go the opposite here. I think what he should do is he's 30 years old. He's got $170,000 in a 401k plan. Switch all of your contributions to Roth because it's the time value of money that matters the most, right? So that $170,000, if he takes the $12,000 that could be contributed to a Roth or his Roth 401k plans, that's less money that he's potentially saving. But if he's maxing out, that's why I was thinking, if he's maxing out his 401k plans and how much is he actually saving and where's he saving it, my answer might change.
Well, and I get your logic, but here's another angle.
Okay.
Which is he's in the 22% bracket, which we know is going away in 2026. So we got 4 years of lower taxes. And being in their early 30s, their income's probably going to go up and they're going to be in higher brackets. So what a better time than to get more money converted than today.
Okay.
So anyway, you could play that either way.
All right, Adam, take that and do what you want with it. I would, I'm a big, at 30, you got 170. I would, all future savings go Roth for sure. And if you want to convert, I'll convert. We got Brent from West Texas. Greetings from the oil field in West Texas.
Do you think his name's really Brent?
Why not? Why would he lie?
West Texas crude? He's talking about the oil fields?
Am I missing an inside joke?
Brent crude oil?
Never heard
Not
that.
Brent. Brent. Brent
crude right now, $42.45.
Oh.
Okay, well, there you go.
Oh,
See, we get educated on this
Brett.
show.
I thought his name was Brad. Anyway, I don't know. What did you write this question yourself? You make it up?
No.
Try to make a little joke here?
No.
He changed the name.
Got it. Well, anyway, Brent crude oil.
He loves the show. 5 stars.
Can I calculate my tax return and use the projected refund amount to pay the taxes on a Roth conversion before the conversion deadline? Let's say it's March 2021. I'm in the 22% tax bracket. I've submitted all documents and completed my tax return with TurboTax, but have not filed. I am projected a federal return of $10,000 for 2020. Before I actually file, I convert $45,000 from a traditional IRA to a Roth IRA, since 22% of $45,000 is $10,000. I update TurboTax with the conversion amounts, and my refund is now zero, since I will owe the taxes from my conversion, which wash from the refund. Okay, I spent my taxes and go on with my life. Does this all sound good to you guys? Brent, no.
You got your years mixed up.
Because the conversion needs to. Here's what you do. You could do this, I suppose. All right, so he's doing a conversion, right, of $45,000, and say, you know what, I'm going to get a refund of $10,000. I want to do the conversion and just kind of update my tax return, and I got the $45,000 in the Roth, and you know what, IRS, just keep the $10,000.
Right. Yeah, so
in theory it sounds good, but the Roth needed to be done in the previous year.
Right. So if you're doing a 2020 return, I guess that's what you're talking about. So in 2021, if you do the conversion in 2021, it's a 2021 income. What you could do though in 2021, when you file your return and there's a $10,000 refund, you could just
apply the refund
it to next year's tax and then it's already in next year. Or if you thought you were going to get a $10,000 refund before, you could do the conversion in December, let's just say.
So
anyway, it's a fine idea. You just have to make sure your years are right.
And Brent, we probably should have knew that.
I was surprised.
There's a lot that you and I don't know. It's because we're so laser focused on our craft.
Yes. I did know Brent crude oil, but I thought it was bent for some reason. It's been a while since I've looked at crude oil, to be honest with you.
Got it.
So that's Brian Perry's job anyway.
It is. Yeah, we don't get involved in that.
Yeah, we're having cocktails. So. All right, that's it for us, folks. Bring in your questions. We'll answer them. If you want really bad advice, you know where to go. Your Money, Your Wealth. We'll be back next week. Show's called Your Money, Your Wealth.
Click Ask Joe and Al in the podcast show notes and get answers to your money questions, possibly. Your Money, Your Wealth is presented by Pure Financial Advisors. For a much more detailed, personalized analysis of your financial situation than you can get from listening to YMYW, click the big green button that says Get an Assessment at yourmoneyyourwealth.com or call 888-994-6257. Schedule a free financial assessment video call with a certified financial planner from Pure. Find out if you're really on track for retirement. Management. Visit yourmoneyyourwealth.com or call 888-994-6257. That's 888-994-6257. Pure Financial Advisors is a registered investment advisor. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the securities or services discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full and informed investment decision.